Welcome to On the Edge, a show examining how deals actually happen in commercial real estate. Host Malcolm Davies, founder of Way Capital, speaks with professionals in development, investment, finance, and more for insights into how these business leaders get deals capitalized. Malcolm's career spans more than 20 years, during which time he has managed nearly $20 billion worth of financings. Now to your host, Malcolm.
Hi, everyone. Welcome to the next edition of On the Edge, Way Capital's podcast on how real estate deals get done. Today, we have one of my good friends in the business, Mr. Jeff Reeder with CenterSquare. Him and I go way back. I think we've realized that we've been in the business a lot longer than maybe others. But Jeff, welcome to On the Edge.
Thank you so much, Malcolm. Happy to be here. Always enjoy speaking with you. And yes, it is. We have known each other for a very long time.
Yeah. I mean, it's, you started in the career and you realize you're like, oh, you're the young person, getting to know everybody, you get up there a little bit, and then you start realizing, wait, I am starting to be one of the older people now in the room.
Yeah.
I think it's so funny. I think the gray does help a little bit when people come up to you and they maybe treat you with a little more regard because of that.
Yeah, that's why I keep a little stubble. It's got some gray in it.
Likewise. So Jeff, look, I'm super excited to have you on today because I think you have been involved in a platform and the growth that you've had over all these years at CenterSquare. But maybe for the audience to say, can you talk about CenterSquare, who you are, and just give that a little bit of background? And then after that, I want to really dive into your personal background because you've been there for a number of years. And I just think it's really cool to see your longevity with one platform. So maybe give the platform the background on CenterSquare.
Yeah, happy to do that. So CenterSquare is a global real estate investment manager. We've got about $15 billion in assets under management, and all we do is real estate, but we invest in real estate across several different strategies. So listed securities, we're actually, a lot of people might not know this, we're the fourth largest independent global REIT manager. Private real estate, which as you know is where I sit. So I'm co-head of our private real estate investment group. And we really focus on residential and industrial. We'll kind of go through the history. We used to cover a lot of other product types, but we've really focused in on where we have the most conviction in terms of fundamentals. And it's so I oversee the residential and industrial, and my partner Rob Haluba oversees our retail operating platform, which has had tremendous growth. Then we have a strategic capital group and also a private debt team as well. So lots of different lenses into real estate.
You've been at the firm now for how many years?
20 years.
Wow. I'll see. There you go. We're going back to the age of ourselves here. Can you give the audience of how you ended up at CenterSquare? And if I'm not mistaken, there used to be a name that I think was Erdang back before it became CenterSquare. It's how long we've known each other. Yes. Maybe can you chat about, how you came to CenterSquare and Erdang and how you got your start in the business?
Yeah. So, went off to school, did not dream of being a real estate investor. I was actually pre-med for my first couple of years, and then decided that wasn't really what I wanted to do. I liked interacting with people. I liked investing. I was an economics major, I liked finance. So went to Wall Street. So did my 6 years in New York, had an amazing run, met a lot of brilliant people, worked really hard, great experience. But as you know, my family's from Los Angeles and eventually wanted to come back home and be close to my parents to be able to take care of them as they aged, et cetera. And I grew up in Los Angeles, so I had my other friends here too. So I came back and I said, I want to do something, all the skills that I learned on Wall Street, but I want to do something tangible. I want to invest in something like a real asset where I can, see a business plan get executed, et cetera. So got into real estate, spent a few years with a small real estate operator, really kind of drinking from the fire hydrant, getting real operator experience. And then this part of the story you may not remember, we did a joint venture with, at the time, as you mentioned, it was called Erdang. And so they were my joint venture partner. Went really well. It was actually a very successful investment. And then based on conversations, CenterSquare is headquartered in Philadelphia. Want to really grow and expand the presence in the Western U.S. So, I worked really well with the gentleman who had kind of planted the flag originally. And he hired me to move on down from Los Angeles to Orange County. And 20 years later, I'm, co-portfolio manager in our value add fund series and co-head of the private real estate group.
And I love it. And, it's interesting. And, one thing is the younger generation looks at, getting into this career. Many people don't spend as much time at one platform as they might have otherwise done in the past. And, you've had a real longevity of being at CenterSquare. you chat about just how you see careers and the like, and in your decision to stay at one platform versus bouncing around a little bit? Maybe chat about that for the audience. I think that's always helpful for the younger folks that watch the podcast.
Yeah, look, it's all about, kind of opportunities and growth. And, one of the things that's been great about, CenterSquare as a platform is, when I joined, it had already been around for 20 years, right? It was founded in 1987. So it was established, but we had a changing of the guard. And when the, new CEO took over, very much a growth focus on taking it to the next level. So that was exciting, where you have an established track record and history, but you still have growth. And so, for me, it was, first growth opportunity was we didn't have much of a presence in the Western US. So I was able to build the brand, meet folks like you and do joint venture deals, et cetera, with a bunch of great people. And that's part of it as well, is just, it comes down to the people, right? This is a people business. So we've always had, good talent here at the firm. And as I moved up in my career, I had great mentors and learned a heck of a lot from, people here and from other people, just in the industry that I work with. And then I got to that stage where I was still constantly being challenged as we evolved. Obviously, we've had these value add funds that you're familiar with for a long time. But I watched the ability for us to grow into a retail operating platform. Strategic Capital was launched as a new business in the last few years. We constantly evolve and innovate, and where we see new opportunities, maybe it's bringing in new core plus strategies. So that constant evolution, where's the next opportunity for growth and expanding? That you're on a platform like that's has a very stable foundation and good history, but is still growing and has that sort of entrepreneurial mindset. That's just very exciting. It's hard to duplicate. And then just part of it's also just become attached to the people. We've got a core group here that I've worked with. So I've been here 20 years, but there's a core group of kind of senior leadership and kind of the next folks up as well on the management curve that also I've worked with for 12, 13 years. So as much as I've stayed here for 20 years, there's a lot of other folks that have also had longevity, and we've all stayed together. And when you're in a boat rowing for a common goal, and everyone's you look around and you like the people that you're rowing with, you trust them, you're gonna take that to the victory line.
Yeah, that's amazing. I go back, I think we did a deal together with one of our clients 10 or 11 years ago, and I'll never forget. It was an office deal, and I remember when you sold it. I think I sent you an email. And I said, man, this is amazing. I pulled up the old OM and the pro forma and then what you sold it for. And honestly, it was like within like $5,000, of like what you thought. And I said, you're too good.
We're very good with our underwriting model. It happens almost every time.
Yeah. So let's talk about, those strategies, because I think in today's, capital market, real estate markets and capital markets, a lot of like things are moving left and right. It's probably one of the more choppier markets I think you and I have been involved in. Unlike the GFC, which was pretty violent and quick and really challenging, but it was like you could kind of tell where we were at a few years after the downturn, right? So here we've been in it for about 3 to 4 years. Things have been choppy. Your firm and you are always strategically looking at different things. So let's talk about just the things you are doing strategically within the verticals. And we'll get maybe even a little dive into that, because I've heard a little bit about the things you are involved in and the things we talk about often. But talk about how that comes to the realization, how you make those actual decisions.
Yeah, and I think great characterization of the market that we're in as well. And so, just in terms of how we've evolved, right? At the end of the day, we're real estate investors. It comes down to the bricks and sticks, the physical characteristics, the location. And so we've always kind of maintained that focus. And so I guess to give examples, real-time examples that folks listening can relate to. So multifamily, like that's been a key piece of our portfolios, across clients, whether it's value add fund or core plus, for many, many years. And, as we headed into 2019, right, 18, 19, things got, we had cap rates dropping and just significant rent growth, more capital coming into multi. It got more and more competitive. And, we kind of had the discipline to fourth quarter 2019, just stop. We still like multifamily fundamentals. I'm not going to say we had this incredible visibility that this massive supply wave was coming at that time. It was just a, valuation discipline. Cap rates aren't going to always be sub 4. That's because interest rates are really low. And so we stopped, and it was, again, more because of valuation. And then we still believed in the fundamental strength of demand for housing, shortage of affordable, for sale housing. So it was just a matter of, but within residential, how do we still attack that theme, right? Okay, so if multifamily doesn't work from a valuation perspective, and the theme is really there is a extreme shortage of, a relatively, attainable entry level housing from a for sale. Well, as you remember, all the new BTR product, that was sort of a new thing. And we had been tracking it. Again, one of the advantages at CenterSquare that I have with my team on the private side is that, we work very closely with and have biweekly calls with all the business leaders, including our REIT team. And so, some of those groups, American Home for Rent, et cetera, we're kind of learning about this. It started off as version 1.0 of the SFR platform, Scatter, but they were starting to do these communities. And so we spent a lot of time studying that and turned around, developed relationships with home builders and, bought. So we still don't want to take development risk, but we bought from home builders that do it best. That's their livelihood. And just took lease up risk. So buy it, certificate of occupancy at a fixed price and take lease up risk. And we were able to get value add returns. So that's how we pivoted and stayed within our rental housing thematic. And then even that got more and more competitive, right? More capital came in. And so those returns compressed, didn't quite hit, became more core plus, which candidly, as you might agree, Malcolm, that's probably the appropriate risk adjusted return, just class A product taking lease up risk. So that made sense. We started looking at development, but with our, we need to have guaranteed maximum price contracts, financing. Market started shifting in 2022, right? Interest rates started increasing. So we didn't pursue development, thankfully. Like everyone always talks about the deals that, they did, right? What we invested in, what helped drive our performance. Sometimes the deals you don't do,
100%.
That discipline can totally shape the, impact your performance. So not doing development was huge. And then fast forward to kind of coming back to traditional multifamily, right? So 2020, COVID hit. We just kept operating our multifamily portfolio, didn't do the renovations. And then 21, rents just took off without us doing anything. And so you start getting to your renovated rents. And 22, comes along and all right, now we can renovate and get even better, higher NOI than we expected and really crush our underwriting. But we're on these public-private calls and the portfolio manager for, our listed team says, hey, Jeff, I know we all see the 10-year going up, but here's what's happening with the multifamily REITs cap rates. Like those are starting to expand. So what we thought was going to happen in terms of returning to a more normalized, cap rate range, which is why we stopped investing in late 2019, is starting to happen. So, I go tell my team, let's go re-underwrite everything and carry out the business plans and renovate, but assume cap rate expansion. You run those models and you're like, okay, sell everything in multifamily, sell by the end of the year before that secret gets out. And that also really helped drive, performance. So just things like that, how we think and, stay within our lanes and our thematic and what we want to do, but be able to strategically pivot and be nimble. And, we were talking earlier about just what's going on in the Sun Belt and supply. And right, we were very active in the Sun Belt, but then all the supply hit. We still had our metrics on what submarkets, what, kind of what we call our scorecard, what we were looking for. Well, late 23, we started pivoting to the Midwest. We said, well, find all these great pockets where people want to be, but you don't have the same kind of supply. So you can actually get some real rent growth and, better yields. And, if you're tracking that stuff, the Midwest is actually, select Midwest markets are holding up pretty well. Even if they don't have the massive population growth, et cetera, it's just a supply. So just, all things how we think. And I guess to bring that full circle, coming back to the, kind of the builder rent, when that got hot and all those developers that did, go buy land, well, now they've, held it for a few years and they say, all right, all the new supply that came on, great. It's starting to stabilize. I don't see a lot of new supply. Here's a good window to go. And so now we're doing a lot of structure, preferred equity in that BTR space. So that was a lot, but that just gives you the whole how we can move through different thematics and attack an investment.
I love the concept of the fact that you pay attention, obviously, to the public markets as it relates to the private markets, because, candidly, I don't think a lot of folks do enough of that. There's the really importance about that. And just in general, that's a real competitive advantage I think that you guys can bring to the table. Let's talk about the industrial market, because I think, you've done and had a lot of success, not only in the residential worlds, but, the industrial marketplace. So we've done some things together, cold storage, for example. But let's talk about where you see the thematic industrial world is from either pure industrial, cold storage industrial? How do you look at that? And what are your thoughts about that space today? Small bay and et cetera.
Yeah. And I'll pick up on the word small. I would say small is mighty. Like right now, that's how we've adjusted. It might not always be the most efficient way to deploy capital, out of a, pretty sizable, fund or for larger clients, but it is definitely a great way to kind of outperform because you go by these, if you track all the data, right? The small, good infill industrial, has had better leasing activity, better pricing power, better occupancy. It's just a little bit more insulated from some of the big macro trends. And for us specifically, we've always done sort of that last mile infill industrial. But now what we're doing is kind of taking it one step further. And we've been in this space for a long time, actually, but we call it service industrial. And so it's just a little bit different where we're talking less than 10,000 square foot suite. So a lot of folks throw around the word small bay, but still more traditional industrial, but maybe it's 25 to 50,000 square foot suites. It's smaller bay, but we're talking less than 10,000, mostly grade level loading, box trucks, vans. And it's really about the tenancy. It's all those small businesses that are, vital to a community, electricians, plumbers, landscapers, those kinds of service providers. So, we were talking earlier just about, lack of clarity and some uncertainty in this market. So for us, it's just about how can we be defensive, like good, strong cash flow. No big tenants are going to, blow up our cash flow, diverse pool of demand. There's all sorts of different kinds of tenants that can use this space and supply, unlike some of the bulk distribution, big box stuff. Like there's not building anymore of this. It's hard to find the infill sites. It's expensive. People don't really want it near the rooftops, et cetera. So, we've really enjoyed that space. And we've been, we're well over 2 million square feet now. We've done it for a few different funds. Our thesis, we kind of built up a portfolio across multiple transactions in our third fund in Las Vegas. We had conviction in the fundamentals that we could execute. The question was, who's your buyer, right? If it's not really quote, institutional, but we were able to, sell to an institutional group, did it again, even a larger portfolio, 8 buildings, 380,000 square feet, sold it to a great institutional group. So we kind of had proved out, the features, the characteristics, the fundamental side of it, and now the exit. And so the last couple of funds, we've been really leaning into it. And it's still, to me, the best kind of risk-adjusted proposition. We can get close to 8 yield on cost, for really high quality infill. Maybe we're down at mid-7, but you're just working a rent roll. It's not a lot of capital, right? You're not compared to development.
And also your tenant base is like not dislocated per se, right? Everyone's talking about it today. It's better to start a painting contracting company than it might be to, get a communications degree. These are things that people talk about. Are you aggregating those portfolios? So are you doing them onesie twosies and building it up and then ultimately selling and trading that to the institutional market as you've gotten into the 7, 8, properties in that portfolio? Or are you actually acquiring the portfolios as well and working those through?
More of the former.
Yeah.
Sometimes we'll acquire just the, 1 or 2 little buildings. Sometimes it's 3 or 4. Mini portfolios, but no, we're not acquiring like 500, 600,000 square foot portfolios for the most part. We're trying to create those portfolios, focus on kind of our identified submarkets, build scale where it's more efficient to manage. And then we have the ability to sell those portfolios, or maybe it's a, Sunbelt portfolio. In that strategy, we've been active in, the Sunbelt, where we're playing kind of the growth angle. But also in the Midwest, where it's just good, established, everyone needs those services. You can just buy it at a higher cap rate.
Sure. What do you see? Like this is part of the kind of on the edge. So you've got all these strategies. You guys do talk internally. How do you plug the strategy? And remind me again, for the audience's perspective, does CenterSquare always use operating partners for your deals? I think the answer is yes. Or sometimes.
Yeah, that's evolved over the years. You know, again, we've known each other for a long time. And when I first joined, everything was joint ventures, local operating partners. That was all we do. But we've evolved. So like our retail operating platform that I mentioned, same, very similar thesis to what we're doing in service industrial. It's just all that necessity, unanchored strip retail. That's an operating platform. We've built up a whole operating platform. We own, we operate. We're the GP, and we've got LP partners on that kind of strategy. In terms of other things we're doing, like in the fund, I would say they're not mutually exclusive. So The service industrial, kind of taking the page from what we've done on the essential service retail is we're more of an operator. We're doing a lot of that direct. But, if an operating partner finds something, everything we're really doing is mostly off market. They find something, they've got the relationship, they've got experience. Yeah, if the return still makes sense and they've got the capability to manage it, because it is management intensive, then that can work. For other, industrial like that we've done, which is heavier repositioning, I think those things we're going to do with a partner. They're usually finding those things off market through their relationships. They have the expertise on the business plan, how to efficiently spend that capital. Multifamily, obviously the preferred equity is really more of a kind of a call it a borrower. Traditional multifamily, we have the capability to do it direct, but there is, so many groups that that's all they do. They live, sleep, and breathe. So we've got some good operating partners. And again, if someone finds something that's unique and off market, with a real value add plan where we're going to actually renovate units and create value, we're doing a lot of that with operating partners too. So kind of situational.
However, the years, and of course it all evolves. I always say that, the operating partner needs to add value. I mean, that we otherwise, you do have a lot of resources internally, as you've talked about, to do a lot of the things on your own accord. How do they get to a level where you feel confident and comfortable doing your first transaction with someone? It's not about, you always hear the folks like, oh, we always do 60 to 70% of our business with a repeat operators. Well, how do you get to be the first? So, generally speaking, what do you look for in those GPs per se when you're evaluating not only the opportunity, but really them?
Yeah, great question. So a few things, and it's a dating process before you get married, as you know.
Sure.
So it's very much, all right, first and foremost, experience and track record in that property type and in that market. There might be cases where we've done some deals with someone, let's just say it's an industrial operator where we've done a bunch in a market. Now they want to expand to a new market. Even though we've done stuff with them, we'll say, okay, but we want to see you do some things in those markets, build up a track record. We don't necessarily want to be your first. So it's very, you've got to be the right operator in that product type in that market. And we just spend a lot of time going through opportunities. Just we don't say, hey, go get something tied up and then send it to us. We're willing to work shoulder to shoulder, understand how you operate, how you think, and how someone presents and how you ask questions. I mean, tip for folks who are out there looking at it, if you just say, hey, here's this deal and send someone an Excel spreadsheet, what do you think? That's usually not going to work. Like we're always going to look at the real estate first. It comes down to real estate before I go digging into any kind of Excel model. So just things like that. And then, you just go through a few reps. You kind of understand through that line of questioning, okay, these folks really get it. They understand it. And then the last piece, coming back to it's a people business. Like, even if it's the most successful investment in the world, if it's the only one we do and it's a one and done, it was a failure. You spend all that time. So is it knowing that is the mindset that we're going to do repeat business over many years? Do we like these people? Do we feel like they're honest and we enjoy spending time with them? Because it's going to be a many-year relationship. That's kind of the last piece of the puzzle. I
feel like you can really mess up a really amazing real estate deal by the human. Humans can make it go poorly, and so it's really a critical business. It's a relationship, human connection business. And, I actually try to always make the comment that, the first thing you need to be able to do is to get along with your partner and see eye to eye all the time. And frankly, you may both be good people, but if you don't see eye to eye, it's really not going to work no matter how it goes. You're not thinking with alignment.
Yeah. And that's the other, and it's probably extra relevant to make this point as we go through the market that we're going through now. Look, not everything's going to work out, right? But there are partners who, we've worked with where, for example, let's say going through the GFC or, any kind of it just didn't work out. Like you can't get everything right all the time, but how an operator handles themselves when they're pretty much don't see a path to promote, if they're still in there and working to do the best that they can, I don't care if that deal didn't do well, that person did well by their actions. So the next deal they come to the table, I'm going to be advocating for it versus maybe the deal did great, but someone was, didn't listen or we've had any kind of questions on integrity. I don't care how well the deal performed. It's got to be the right person and partner.
I feel like that what you just said right there is probably the most important part of this business, that your integrity, your ability to keep going and have the fortitude to keep proceeding along because it's the best interest in your fiduciary to your capital partners, regardless of what happens to you. I think that's a real component. Markets. I mean, generally speaking, right now we are in a choppy market. Interest rates have definitely been correlated a bit with cap rates, not entirely, but the reality is there's a lot of correlation. Regions of the country, You have some places that have growth, some places that do not. You have some states that are more difficult to work and transact in, some places that are easier. Where are we today right now? And how do you see kind of where we sit here in the going into the winter or fall of 2025 and into 26 and 27? What's your thoughts?
Yeah, I think you set the table really well because we're coming out of a cycle where you didn't have that differentiation. All multifamily was equal, all industrial was equal. Everything was up and to the right because that was just the environment we were in. So I think where we come back to is there's certainly uncertainty around, future growth, the labor market, all the inflation. There's enough uncertainty. But I think from talking to a lot of investors, folks are coming to the conclusion that, okay, like the bottom's not going to fall out, specifically for real estate, right? Like real estate's kind of gone through its correction. So you're not going to be catching a falling knife. And okay, you're not going to have a V-shaped bounce back recovery. It's going to be slow and choppy, which I agree with. But as long as you have some clarity, so like interest rates, right? Yeah, the long term, 10-year, I think we're going to kind of bounce in a range.
Yeah.
Going back to the super low, but we're not going to have runaway rates. So maybe we hang in that, call it 4 to 4.5. And at least then that gives investors, okay, I know what I can work with. It gives lenders some confidence in what they can work with. And I would say right now we're seeing, and you see this probably even way more than I do, lenders are coming back. So there's good appetite there. So that's obviously important. Investors are definitely the big institutional investors because there's been some transaction activity, but it's mostly the private, smaller investors. The big institutions are starting to come back again. They're picking up their pencils. They're looking, feeling a little bit better. And they kind of recognize, all right. And if you kind of look at past cycles, getting in after the first couple of years of that dislocation, like you don't have to time it perfectly, but as long as you're not still catching that bottom, which most people agree we're not, all right, we feel good that now's a good time to enter. But I think it just comes back down to then to be successful in that kind of an environment of, hey, maybe it's a little bit slower growth, in that kind of, world. It comes back to the basic real estate 101, right? I'll call it the AAA, right? Asset selection. You got to differentiate. You got to know your bricks and sticks and understand why one piece of real estate is better than the other. Across, pick the right sectors, and then within the right sectors, pick the right real estate. I would say you have to add value. You're not just going to grow by market rent growth or cap rate compression like we had in the past. Like you need to have an active business plan and be able to actually create value, something that grows NOI. And then the other A would be active management, right? You got to just stay on it. Like you can't, here's my underwriting, my performance, my business plan. I'm going to laminate that, put it on the shelf, and there we go. That's just not the world. And even more so now than maybe at other points in my career. It's just, there's always that choppiness, uncertainty. Even when there's always uncertainty, right? Yeah. We're very certain that interest rates are going to stay low forever. And you felt like you had certainty. We saw how that played out. So always being able to kind of read the leaves of constantly being in touch with the market and trying to get ahead of any major shifts that's just prudent investing. And that's hasn't changed, but I think people are starting to realize, okay, that last part of the cycle was the anomaly and it's back to real estate investing 101. Sure.
And I think that the good news for, I think, investors and for participants in the market, I feel like we've hit kind of we've been choppy for, when we get into 26, we've been choppy for almost a half a decade, it seems like, right? And you'll start to see that there's some clarity in, the way the cycles are. This one was choppier because I think when you added the COVID boom and the amount of liquidity that was pumped into the system and the like, it made it a little bit complex, to say the least. And so, deleveraging ultimately happened and something we all had to deal with. But, you got to think about the bigger picture and think about your investment thesis is going to be the end of the 2020s going into the early 2030s, which for God's sakes, that makes you and I feel like we're very old as two guys that just turned 50. What would you recommend to folks that are getting into the business today that, that you look back at your career? I would say for myself personally was, being a developer early on was a great thing. It taught me a lot, took an awful lot of risk about it. But, I look at it and think, gosh, what would I do today? And I always ask our guests, if you were entering the commercial real estate world today, what would you recommend for them to do, to get their, quote unquote, feet wet in the business?
Yeah. I mean, coming back to it's a people business, talk to as many people as you can, get all sorts of different perspectives, be intellectually curious, constantly be open to learning and growing. Don't feel like you're entitled to, move up the ladder into anything, right? It's just, you got to put in, nothing beats hard work, if you do a good job working with the right kinds of people and learning, it comes back to you in spades. Like I wouldn't be where I am without kind of taking that approach. And then people open up doors and, you go from there. And then, at this point, you and I are in a career where we can kind of pay it forward, right? Like now I can be that mentor for other people. But I think that's kind of a key thing. And, just being humble at the end of the day and just, I've seen many a overly confident ego kind of derail a career.
Well, I mean, it's funny. I always think to myself going, what did the GFC teach me as a developer who went bankrupt in the GFC? Humility. And it was the greatest gift that could ever been given. And I didn't have it before. And you don't know that about yourself, when you're egotistical and arrogant, so to speak. In 05, 06, I would say that about myself. But the reality is humility is you're very, very on point on that one. I think that's something, if you can have that in your disposition, I think you can take that really far. Doesn't mean that you don't have to be confident. Doesn't mean that you don't have to be really persistent in your career, but humility is a great element.
Yeah, I 100% agree with that. And even by humility, it doesn't necessarily have to just be how your external interaction with people.
Yes.
But just when you're underwriting something, just not thinking that you know everything. Like all your assumptions, like, hey, I put this in this model, it's 100% right. Just question yourself, test yourself, run the downside. And if everything kind of survives that, your own questioning and input from a whole bunch of other people, all right, then it's probably gives you good investment discipline there. If you're just on your own thinking, yeah, I've got this, I know it, that's where you get hurt more.
I totally agree. So listen, Jeff, I promised you around 30 minutes. I can't thank you enough for being the next guest on The Edge. And I'm pretty darn sure that people are going to love this one. On behalf of myself and our team here at Way Capital, can't thank you enough for being a guest on this, and appreciate it, and see you at the next conference, my friend.
My pleasure, an honor and privilege. And I appreciate our friendship over these many years.
Likewise. All right, bud.
All right. Thanks, Malcolm. Take care.
Thanks for taking the time to tune into our latest show. As always, you can find us through our YouTube channel at youtube.com/@wayontheedge or at our website at www.waycapital.com. Until next time, keep working on the edge.